Most retirement plans are built around one assumption, that your portfolio will earn enough on average to fund your life. But averages do not determine whether your money survives. The order in which returns occur is what matters. Now, we can have two investors and they can retire with the same portfolio. They could withdraw the same amount and they could even earn the exact same average return. Yet one preserves their wealth while the other is forced to liquidate assets at the worst possible moment. Now, that's because the greatest threat to your wealth is not volatility. We actually like volatility. The threat is needing liquidity when markets are down, when income has fallen, and inflation is still compounding against you. So in this video, I want to show you how to build a 3-year liquidity structure designed to prevent forced selling, how to survive prolonged drawdowns, and dramatically reduce the risk of ever outliving your money. So let's go. All right, so let's talk about the numbers and how this affects you. Again, volatility is not the problem, it's surviving volatility. So let's talk about the tale of two people. We can have two retirees, both have the same balance. They both have the same average return, but they could end up in completely different places. And the reason why is because what happens to them from point A to point B, or more specifically, how they handle what happens to them along the way. Now, unfortunately, you probably already know this, but markets don't move in straight lines. There's never been a market that went straight up, nor do they go straight down. And so there's volatility along the way. And as I said, that's not the problem. It's surviving the volatility. It's not being a forced seller. Now, let me give you an example of my own life. I started my career in real estate investing. I built up a couple tech companies, had some big exits. I put that money back into real estate. And in 2008, we had the great financial crash. And here in Southern California, it was one of the hardest hit markets in the entire country and probably the entire world. In Southern California, the properties I had lost 60% of their value in less than 12 months. Highly volatile. Big problem. Now, some of my friends that were in real estate during that time managed to ride that volatility out. And today those properties are worth a lot of money. But unfortunately for me, I wasn't able to ride the volatility out. Unfortunately for me, some of my properties had to go back to the bank for pennies on the dollar. And when I say pennies, I mean pennies. One of the properties, I had just recently refinanced it, meaning the bank had done an appraisal on it, and they refinanced for about $2.2 million. It ended up going back to the bank, and the bank sold it for less than the cost of the materials it cost me to build the house. I mean, are you kidding me? But that's what happened, and so I wasn't able to hold on to those assets. If I was able to, today they would be worth multiple times of what they were at the time. So what we want to think about is not just the balance that I have, or the return that I have, but the distance is going to take me to get to my goal. So for example, if I have a retirement plan that's forcing me to sell some of my assets, traditional portfolio management says that I can sell about 4% of my assets per year. But what happens in a downturn? In 2008, the markets dropped about 60% and took 7 years just to reclaim its previous all-time high. So if I was selling my portfolio in those down years, I'm going to run out of money much faster. So if volatility is not the problem, and I would even go as far as to say volatility is our friend, because it goes both ways. I want my assets to be volatile to the upside, just not to the downside, but I can't have my cake and eat it too. So I have to be prepared for the volatility to the downside. So the question is, how do I survive it? Well, the answer is different for everybody, but let me walk you through a process to help you think through this. So first of all, I don't pretend there's no such thing as risk. I don't put my head in the sand. I want to understand every potential risk that could happen so I can build a mitigation plan for every single one of those. It's quite different than most people think. Is it risky? Sure, but let's think through that and let's engineer a way around that. So how much volatility do I expect in this asset that I hold? How long will it take to overcome that volatility? So for example, I have Bitcoin. Okay, well, Bitcoin moves in 4-year cycles. Historically, it's moved in 4-year cycles, and there's never been a point in Bitcoin's history you could have bought any top of the market ever, and within 4 years, you'd be back in profit. With real estate, we typically had the rule it was 5 years. 5 years is sort of the cycle of real estate. So number one, time. If I'm going to buy Bitcoin, I need to be prepared for like a 4-year dip. If it's real estate, a 5-year dip. And so if I'm in real estate, I'm in multifamily real estate investing, or I have duplexes or single family homes that are rentals. I owe money on those things. I have obligations. I have debt against those. And if the market downturns, will I be able to continue to afford that? So number one, liquidity layer. One, do I have the operating income to cover those? Sure, I make 40 grand a month. I only spend 5, so I have a $35,000 a month surplus. It covers all my rental payments multiple times. No worries. Okay. Great, but maybe that's not the case for you. Okay, my operating income barely covers it, but if something happens to my income, I have a problem. Great. well, then I need to build a backup number 2. I think about this like risk mitigation steps. So again, if I want to go in the ocean swimming, I could learn how to swim and I could put a life jacket on, and I could take a float with me, and I could bring a lifeguard with me. So I can continue to add steps. So number 1, do I have the operating income? How long could I continue to make those debt obligations? For me, in my own real estate experience, as I said, I had sold my businesses and I put the money into real estate. So I didn't have the operating income to cover those real estate properties. As a matter of fact, this building that I'm recording from was one that I built, and now I'm renting from them today. And my payment on this building was over $100,000 a month. And it was a hard money loan, and I couldn't afford to cover that payment for very long with no businesses. So I didn't have the operating income. I ran out of money. Then number 2, I would want to build another mitigation step, which is what I call cash equivalents. I call these cash equivalents. It's not cash, but it's cash equivalents. So this might be short-term treasury bills making 3, 4, 5%, money market accounts 4 or 5%. It could be other stable plays, credit funds where I could put money in, maintain my balance, but make higher yields, but I could turn them into cash if I need them. Okay, and then, so let's say that, okay, well, shoot, this was really bad. It was worse than 2008. And yeah, my business suffered. I ran out of cash, and shoot, I went through all my cash equivalents. Now, you might ask a question before I go to the 3rd and 4th layers. Well, how much should I have in layer 1 and layer 2? Well, it depends. These are not hard and steadfast rules. These are numbers that all work together based off of the debt ratios, the obligations, and things that you have. So for example, I like to reference Michael Saylor and strategy quite often, and you can see that we're going through a very long bear market in Bitcoin. Because of that, his MicroStrategy share price is way down. But he continues to add more debt and more debt obligations. So he just announced this last week that he's now raised up to $3.6 billion of cash in layer 2. Why? Because he wants to make sure that he can continue to build and push even harder without taking undue risk. That's layer number 2. But let's say that I run out of that. Well, then do I have more liquidity I can access? Now, cash is liquidity, but liquidity is not cash. Liquidity is the ability to get cash. So do I have other assets that I can get liquidity against? Do I have credit lines open, business credit lines open? Do I have a home equity lines open against properties I have? Do I have lending facilities set up against my Bitcoin? What other assets do I have that I can get liquidity against if I need to cover me in the short term in order to hang on to those assets? And then finally, number 4 is the ultimate protection. We don't want to go there unless we have to, unless we blow through all other 3 layers. But layer 4 are the assets themselves. Do I have assets that I could sell to ultimately cover and hang on to what I have? It becomes a mitigation if it gets to that level. Now, again, how much goes into layer 1, layer 2, layer 3, layer 4? Well, that comes down to calculations. It's based off of a bunch of things. Where are we at in the market cycle? What are my LTV ratios? What are my operating expenses? What are the obligations that I have? How recession resistant is my income? It comes into a whole bunch of things. And these are living, breathing, moving numbers. For example, at Bitcoin's peak in the market cycle at 126, if I would have borrowed, let's say 40% LTV on that, I never got a margin call. But if I borrowed at 60%, I could have got liquidated unless I had layers 1, 2, and 3 built up. Now, today, we're at the bottom of the market cycle. I could probably borrow even more today. But again, I'm not telling you, I don't want to help you set your numbers because it depends on all of them together in one cohesive structure and system. Now, this may sound scary, right? Mark, you blew yourself up in 2008. Sure, that's before I knew the rules. But Mark, what about Michael Saylor? I heard he's going to get liquidated. Well, he's got $3.6 billion of cash and he's got 30 years of assets to cover that. And so while it sounds risky, it's risk that we can mitigate. But let me tell you what the real risk is. You see, most people operate in this thinking that there's risk if I do something like this, but if I don't do it, then I don't take any risk. But that's not the truth. As a matter of fact, that's further from the truth. Let me give you an example. So currently, right now, over the last about 6 years, the money supply is expanding about 8% to 10% a year. That's the true cost of living going up, not the CPI number they report to you. And just look, how much has your gas gone up, or your steaks gone up, or your housing gone up, right? Your insurance, how much has your insurance gone up? So if my cost of living is going up about 8 to 10% per year, that's my true number I have to beat. What happens if I don't beat that number? So the S&P 500 is sort of like a perfect proxy for inflation. It's not really beating it, but it keeps up with it. But most of you don't just buy the S&P 500. You probably have some sort of a 60-40 portfolio or some sort of like an all-weather portfolio. You probably have your fund manager put in a 401k. And so your returns are probably more in the 6.5-7% range, which means you're losing money today. So you can't operate in a paradigm where, wow, that sounds risky if I do it, but if there's not, then I don't take risk. Because if you don't, the risk is that you're not going to have enough money to retire. Your money will not last long enough for you to live. And that sounds like a terrible risk. It is. So how do you mitigate that risk? Well, you build a structure to get you better returns, like I've been talking about. But Mark, that sounds risky. Yeah, but we can understand what those risks are and we can build a system to mitigate those. So you can't believe that there's risk or no risk. For example, I like to go to the gym and work out. And when I go to the gym and work out, I take risk. I can get in a car accident on the way there. I could drop a weight on my foot. I could hurt my shoulder when I'm lifting weights. That's risky. So let me just stay home because there's no risk, except for now I risk obesity and heart disease and depression, right? How do you mitigate those risks? Well, you go to the gym. Well, how do I mitigate the risk of hurting my shoulders? Well, I have someone spot me. I use proper form. I use proper weights. And so I want to just kind of real quickly say that it's not about risk or no risk. Everything has risks. It's an understanding that has risks. It's identifying those risks and engineering a way to mitigate those. Now, real quick, there's a QR code that you'll see on the screen right now that you can just scan if you want. And if you want to see how these strategies apply to your specific situation and actually understand how all these numbers work together, my team would love to walk through your numbers and help you build a personalized wealth operating system. So check out a link in the description down below, scan the QR code that's on the screen right here, and then come back because we've still got more important part ahead. All right, so now that we sort of understand that there's risk or there's no risk, and I can do things to mitigate the risk, but it really comes down to making sure I have these numbers right, then we have to put those into what we call rules. So if you have a corporation, you have bylaws. In my fund, we have a Bitcoin venture fund called the Bitcoin Opportunity Fund, by the way. And we have rules of what we can invest into, what we can't invest into, how much risk or leverage we can take, how we hedge our positions. And there's rules that govern that, all right? And so we need to also create rules because emotions are the investor's worst enemy. And we're emotional beings as humans. And what happens is we get caught up in the moment because we're motivated by pain and pleasure. I want to rush to pleasure. Everyone's making money. Look how much. Elon Musk, SpaceX, let's all rush in. I caught up in the emotion in the moment. And then SpaceX is down 50%. You lost your wealth. And so then I run because I hate pain. I want to sell and get away from that because I have pain, and I sell at the worst possible time. I bought high, I sold low. And so we want to take the emotion out of it, and we want to put in rules in place. You ever been to the grocery store when you're hungry? Everything looks good, which is why you go to the grocery store with a list. What do you need to pick up from the store? And so we want to put those rules into place. What are my LTV ratios that I won't exceed? What are my liquidity numbers that I need before I can do the next steps? What are these rules? And they need to be established in advance so it takes the emotion out. It's thought through intentionally so you can build wealth. And that's how you protect and build your wealth fast. All right, so, building these buffers out, building the layers, it's not something that you just build once and forget. I mean, I did say you put them into rules, but those rules need to change as you change, as the market change, as your expenses shift, right? As inflation keeps grinding away in the background and your liquidity stack that covered you, a year or 2 years ago, maybe it's not enough today. And you won't know it until, unfortunately, you're forced to sell. That's why this only works as a living system. It's not a one-time fix. You have to tie your liquidity, your leverage, your taxes, all of that together into what we call a wealth operating system. And I'll put it here on the screen one more time if you want to scan that. I'll put a link in the description down below. And go ahead and click it, and I'll show you how to keep that buffer solid for good. I'll see you there.